Assalamualaikum warahmatullahi wabarakatuh. We are from Group C, and today we'd like to present the result of case study 1 from the Financial Market Institution course. Before we begin, let me introduce our team. Our members are myself, Sosial Farja Mewandi, Naila Rahma Fadila, Umaimatul Ignasia Elsa, and Meita Ratu Fijarina. So the next one, the first question of the first case study will be explained by Naila.
Okay, so the first question is expansion of Nova Animation Studios. Nova Animation Studios is a well-established animation company operating in Canada. In recent years, the animation industry has experienced rapid growth, with increasing demand for high-quality animated content. Recognizing this opportunity, the company's management is considering an expansion plan to increase production capacity and enhance its competitiveness in the global market. One of the projects currently being evaluated by financial team in the expansion of Nova Animation Studios production facilities. This expansion includes building a new studio, upgrading production equipment, and hiring additional talent. However, the project requires a significant initial investment of $4 billion as a part of financial analysis. The team has projected the expected cash inflows from the expansion. According to estimates, the project is expected to generate annual cash flow from $675 for 16 years. To assess the feasibility of this investment, the company applies a discount rate of 11%, which reflects the cost of capital and project risk. The management now faces a critical question. Is this expansion financially viable? As a financial analyst tasked with providing recommendation to the CEO and shareholders, you are required to evaluate the project using three keys investment analysis methods. 1. Net present value. Calculate the net present value of this project. 2. Profitability index. Determine the profitability of the product relative to the initial investment. 3. Internal rate of return. Find the internal rate of return for the project. After calculating these three metrics, provide a recommendation to the management. Should Nova Animation Studios proceed with the expansion? Why or why not? Use your financial analysis to support a strategic business decision for the company. Next. So here's for the solution. From the question, we know the CF0 is $4 million, annual cash flow $675, year 16 years, and discount rate 11%. First, we calculate the NPV. The formula is minus CF0 plus CF1 divided 1 plus K exponent n. After that, we substitute the CFO, which is minus $4 million plus 675 divided 1 plus 0.11 exponent 1. We continue this calculation from 1 until 16. So here's we got the calculation of the below ones. We got 1.11, 1.23, 1.4, 1.5, 1.7, 1.9, 2.7, 2.30, 2.55, 2.83, 3.15, 3.5, 3.9, 4.31, 4.8, and 4.31. From the calculation, we got the 608,108 and 1 $548,780, $482,142, 457 and 19, 397.58, 355,263, 326.86, $478, 200.6, 705, $238, 515, and each other. So from this, we got the $965 thousand six 736,039. Based on the calculation, net present value of this project is positive. Number 2 is profitability index. From this profitability index, we got 1.24%, and it's more than 1, so the project is valuable. And number 3, we calculate the internal rate of return. We got the example of if the discount rate is 14%, the NPV, we got the NPV is $650. And if the discount rate the 16%, we got the negative $199,000. Next we calculate the linear interpolation. ERR equal 14%, 207,650 divided 207,650 minus negative 199,000 times 16% minus 15%. We got from this calculation we got 1.2%. So 15% plus 1.2% is 15.2%. The internal rate of return of this project is 15.2% and higher than the company discount rate. It means the project offers a good return on investment. Next slide. So for the conclusion and recommendation, based on the financial analysis conducted, Nova Animation Studios should proceed with the expansion. The positive net present value of $965,736,309 confirms that the project will generate value for the company. Additionally, the profitability index of 1.25 24% exceed the threshold of 1, indicating that the benefits of the project outweigh its costs. Furthermore, the internal rate of return of 15.2% surpasses the company's discount rate of 11%, highlighting that the project offers an attractive return on investment. The project satisfies all key financial criteria, and the final decision, the project is accepted.
Okay, now the study case number 2, expansion of Velocity X motor product line. Velocity X Motor, a well-known manufacturer of high-performance skateboards, Velocity X Motors, a well-known manufacturer of high-performance skateboards in Australia, is considering expanding its product line to include gas-powered skateboards. With the rising demand for alternative transportation solutions, the company sees this as an opportunity to attract new customers and boost sales. The management believes that the company can sell 2,000 units per year over the next 10 years, after which solar-powered skateboards are expected to dominate the market, leading to the discontinuation of gas-powered models. Each gas-powered skateboard is expected to retail for $200 with variable cost of $40 per unit. Additionally, annual fixed costs related to production will amount to $160,000. To support this new product line, the company must invest $450,000 in new production equipment. The financial team has decided to use the simplified straight-line depreciation method, which means the equipment's value will be fully depreciated over the 10-year lifespan of the project. The project will also require an initial investment of $50,000 in net working capital for inventory and operational needs. However, this amount will be fully recovered when the project reaches the end of its life cycle. From a tax perspective, the company's marginal tax rate is 34%. To determine whether this expansion is a viable investment, the management has requested a thorough financial evaluation. As a financial analyst, your role is analyze the feasibility of this expansion by addressing the following key financial aspects. First, initial investment requirement. Second, annual net cash flow estimation. 3, terminal cash flow in year 10. 4, investment viability through NPV analysis. Okay, and this is the solution. First, initial investment requirement. The total initial cash outlay needed to launch this project is $500,000, which is get from invest in new production equipment plus initial investment in net working capital. So for $150,000 plus $50,000. And the answer is $500,000. Second is annual net cash flow estimation. Before we estimate the net cash flow, we need to understand the info that given in the question. From the question, we know that the total units the company plans to produce is 2,000 units, with a selling price is $200, and the variable cost is $40 per unit, with fixed cost $160,000. The investment in new production equipment is $450,000, and the initial investment in net working capital is $50,000. And the project life in this project is 10 years. And the equipment will be fully depreciated by the end of the project. So the salvage value at year 10 is 0. The annual depreciation or depreciation expense is $45,000, which is get from purchase value, which is $450,000, divided by project life is 10 years. So we got 45,000. The tax rate is 34%, and to calculate NPV, we're given a discount rate of 10%. So the formula we'll use is free cash flow equals net operating income minus taxes plus depreciation expense minus increase in capital expenditure minus increase in net capital operating working. So the first step, we calculate the NOPAT first. And for that, for calculation the NOPAT, we can use income statement to calculate the NOPAT. But before that, we should identify what information we need to use in the income statement. First, we should calculate the revenue. Revenue is the formula of revenue is quantity times price. So 200 times 2000. So the revenue is 400,000. The next one, we should find the COGS, cost of goods and sales. The formula of cost of goods and sales is fixed cost plus variable cost times Q. So the fixed cost is 160,000 plus variable cost is 40 and the quantity is 2000. So we get 240,000. And then we put into the income statement the revenue minus COGS. So we got 400,000 minus 240,000. And the gross profit is 160,000. Then we subtract again with depreciation expense, which is 45,000. So we got earning before tax or net operating income, which is 115,000. After that, we subtract again with tax, which is 34%. So 150,000 times 34%, and we got 39,100. And then we subtract the EBT and tax, and we got NOPAT. The NOPAT is 75,900. And then from the formula, we added back the depreciation expense. So 75,900 plus 45,000. Then we got 120,900, which is the operating cash flow. Now we can plug all this calculation into a simple table to make it easier to see the cash flow for each year. For year 0, the operating cash flow is 0, and the last capex is minus 450,000, and less NOWC is minus 50,000. And then the total is minus 500,000. So in year of 0, the total cash flow at year 0 is minus 500,000. So based on the calculation above, the net cash flow obtained in year 1 to 9, or answer the point second, the annual net cash flow estimation is $120,900. It's terminal cash flow estimation in year 10. Based on the calculation above, the terminal cash flow estimation in year 10 is 170,900, which is get from operating cash flow 120,900 plus less NOWC 50,000. So the NOWC is added back to the cash flow. Number 4, investment viability through NPV analysis. So the next step is calculating the NPV. So based on the NPV calculation, The resulting of NPV value is 262,155.35, which is a positive result. So this is indicates that the project will provide profits to the company and contribute positively to its financial performance. Therefore, the project is considered feasible to be accepted or proceeded with. From year 1 to year 9, the project will generate an additional profit of 120,900 per year, while in year 10, it will provide an additional profit of 170,900 due to the inclusion of the recovered the net operating working capital. So the recommendation for this project, based on this result, it is recommended that the company proceed with the project implementation as it is expected to deliver significant financial benefits in both the short and long term.
Okay, so this is third question. Quantum Tech Solutions, a leading technology firm based in Japan, is considering the construction of a new production facility to manufacture its latest line of high-performance memory cards. With increasing global demand for data storage solutions, the management believes that expanding production capacity could be a strategic move to capture a larger market share. The proposed production facility will require an initial investment of 800 million yen and is expected to operate for 5 years. The financial team has decided to use the straight line depreciation method, meaning the facility's value will be fully depreciated over its useful life. The company anticipates selling of the new memory cards at 1,500 yen per unit. However, the production process involves certain costs. Variable production cost per unit is 10,000 yen. Fixed salary expenses per year, 180 million yen. Before proceeding with the investment, the company's executives want to analyze the financial feasibility of the project. They have requested a break-even analysis to determine the minimum number of memory cards that must be sold annually to cover production costs. Your task as a financial analyst is one break-even analysis. Calculate the accounting break-even number of memory cards of the company needs to sell each year. Two strategic recommendation. Based on the break-even analysis, should Quantum Tech Solutions proceed with the expansion? What potential risks and challenges should the company consider before making the financial decision? Prepare a financial report with your findings and recommendations, considering industry trends, production efficiency, and market demand. Next. Yeah. This is the solution. First, we have find the break-even analysis. We will use BIP formula or break-even point. Why use the break-even point? Because it's to find out the minimum number of units that must be sold to cover all costs, both fixed costs and variable costs. And this case study, break-even point is done before making an expansion decision. Given data, initial investment 800 million yen, depreciation in 5 years is 180 million yen. Depreciation in 5 years is 160 million, obtained in initial investment divided year and fixed salary expense 180 million. Selling price per unit is 15,000 yen. Variable cost per unit is 10,000 yen. Total fixed cost per year is 340 million, is obtained from fixed salary expense divided depreciation. Okay. Next is break-even point. The formula is fixed cost divided selling price minus variable cost. 340 million yen divided 1,500 yen minus 1,000 as 340 million yen divided 15,000 yen minus 10,000 yen is 340 million divided 5,000. The result of the break-even point that we calculated so that quantum technology must sell a minimum of 68,000 units per year to break even. From the result of the BIP calculation for expansion facilities, next. Okay, from the result of the break-even point that we calculated. From the result of the break-even point calculation from expansion feasibility, it can be concluded that expansion feasibility, if the project annual sales exceeds 68,000 units, that expansion is considered financially feasible. On the other hand, if the estimated sales are lower than that figure, the company may be at risk of incurring losses and should reconsider its investment decision. Before deciding the process with expansion, the company also needs to consider the following risks and challenges. Before making a final decision, Quantum Tech Solutions should carefully evaluate the following key factors. This one, market volatility. The technology industry is fast-moving and unpredictable. Rapid innovation and new market entrants can quickly change demand dynamics and pricing power. The company must assess whether it can maintain a competitive edge amid evolving trends and consumer preference. And two, operational risks. Potential delays in construction, production setup, or supply chain disruptions may increase total project costs and delay market entry. Evaluating internal red lines and supplier reliability is essential before proceeding. And three, sales volume uncertainty. The company must meet the minimum sales target of 68,000 units annually to break even. Falling short could result in significant financial loss. Accurate forecasting and through market research are critical to reduction the risk. And four, the last one is currency fluctuations. Exchange rate volatility can impact both material costs and export revenues. The company should consider hedging strategies to safeguard margins against adverse currency movement. So this conclusion and final recommendation. Based on the break-even analysis and strategic review, it's a recommendation that Quantum Tech Solutions proceed with the expansion only if annual sales can be realistically project to exceed 68,000 units, ensuring financial feasibility. The decision should be supported by a comprehensive market analysis to confirm sufficient demand across target regions. Additionally, the company must prepare a contingency plan to address potential operational risks such as construction delays, supply disruption, or cost awareness, ensuring the expansion remains sustainable even under challenging conditions. Next.
Okay. Now, next is question number 4. Equipment acquisition decision at Nexatech Solution. First of all, we know that Nexatech Solution is considering two alternative financing methods to acquire high-speed precision equipment with a loan or a lease agreement. Next. The first assumption is the initial loan of the year that we know is 250 million won, 6 years, interest rate 9%, equipment cost 250 million won, residual value 30 million won, tax 35%. So we go into the present value of annuity formula. The result is 51,127,881. And next is depreciation expense 250 million 30 million colon 6 equal is 36,666,667. After tax cost of debt, interest minus 1 times tax 9%, 1 mean 35%. We got 5.85%. The next step is to create a table schedule of cash outflow. Year 0, loan payment can be from the previous one, namely 51,127,881. Interest depreciation tax shield does not exist because it's still year 0. COF after tax is Okay, the next step is to create a table schedule of cash outflow. With 0, loan payment can be from the previous one, namely 51,127,881. Interest, depreciation, tax yield does not exist yet because it's still year 0. COF after tax is obtained from column 2 plus column 3 times tax, which is 35%. PVIF is seen from the table because this is year 0, so the value is 1. PV of COF is obtained from column 5 times 6. Here, first year, still the same loan is 51,127,881. Interest is obtained from the calculation in the table schedule of debt payment. The rest is the same until then, and you get the result of 172,728,038. For the PVIF use 5.85. Next slide. Okay, next slide is loan payment, the end of the year. Loan payment got 55,730,170 in here. The next step is create schedule of debt payment. Loan payment using the value remaining balance in 250 million minus 55,730,170. Interest 9% times principal prepayment, column B minus column C, and so on. Next, create a cash outflow schedule table using the same method as before and use PVIF 0.85%, and we got 172,733,437. Next slide. Okay, based on the loan payment analyzed, debt financing result in an after-tax interest cost of 14,625,000 won per year. The total payment over 6 years amount to approximately 334,381,062 won. After accounting for the residual value and applying the discount factor, the present value of cash outflow is around 172,733,437 won. The company gains a tax benefit from depreciation totaling 77 million won over 6 years. This is show that despite the interest expense, the tax advance from both interest and depreciation make loan financing financial favorable in the long run. Next. Okay. For the leasing option, the annual lease payment is 52 million won over a period of 6 years. Totaling 312 million won. After paying the 35% tax yield, the after-tax lease cost is 33,800,000 won per year. Next, using a 5% discount rate, the present value of the total cash outflow is 171,558,661, assuming payment are made at the end of each year. They reflect the actual cost the company after accounting for tax saving. Next. For final recommendation, based on present value analysis and strategic considering the lease option is more benefit with a lower total cost of around 171 million won compared to the loan. Leasing also provide greater flexibility, support liquidity, and keeps the balance sheet lighter. Nexatech is advised to process with the lease agreement to Prime Leasing Corporation. Next.
Okay, so that's all from our group. We apologize if there are any mistakes. Thank you for the attention. Wassalamualaikum warahmatullahi wabarakatuh.